deferred capital gains taxation. And we can say that they are applied only to the gain, gain there on the value of an asset, applied only to the gain on the value of an asset. We put a full stop there and we say that this tax can be controlled at the point of sale. That's why we're saying capital gains tax was an easy way of how the government could actually raise taxation when buying and selling of securities here in Kenya. And of course, you are aware that capital gains tax was actually abolished because of the obvious effects of the obvious reasons of individuals trying to identify the prices at which they bought. For example, an individual bought shares in 1980 or 1985, and the price has actually risen and actually dropped there, and no one was actually keeping records of the time when an individual actually bought shares. So it becomes difficult to trace back the price at which an individual bought the shares, and if there's any capital gains that have actually been realized based on the share price today. So we are saying it can be controlled since it is only applied when the asset is sold. It can be controlled since it's only applied when the asset is sold. So the formula for calculating deferred capital gains taxation, so the FV of investment value, AT, just similar to the way we've done the things, the future value after tax, under accrual tax. But now we're not talking about simple accrual taxation. We're talking about deferred capital gains taxation over there. So we put this CGT, and we can be able to put that as 1 plus R, like that, power n, and then we multiply that against 1 minus taxation over there, CGT, like that, and then we add TCGT times B times there. So let me put this so that you can be able to avoid confusion. So this is T. Future value, 1 plus R power n, 1 minus T, which is this T, capital gains tax, deferred capital gains tax over there, plus T, capital gains tax, times the B there, times B. So this, of course, is a key concept that needs to be put in a box there, and we can be able to answer the following question using that concept. 1,000 is invested for 20 years at a pre-tax return of 10%. Return is subject to a deferred capital gains tax of 30%. Compute the ending after-tax account value and the tax drag. The cost basis is also 1,000 and B is 1. So we are saying that the B represents the cost basis. Rather, the B is given as the cost basis divided by the asset value in the short term. So B is equals to cost basis divided by asset value at the start. Asset value at the start. There. So we already explained what T is. T, CGT, T, CGT, B is what I have not explained. Since B is given as a cost basis divided by the asset value at the start. So moving on to this other side, ladies and gentlemen, we can say the following. That since we are going to apply that, so we have the future value of CGT is given as, what is our 1 plus R? We have the formula written to us there. So we have the amount. The amount is given to us as 1,000 into, we are saying 1 plus R, 1 plus 0.1, power what? 20 years there, based on the formula. And then we have 1 minus the taxation rate. The tax rate given to us, the deferred tax is 30%, 0.3. And then we are saying we are going to then add the taxation of CGT, which you're saying is 30%, 0.3. And we have been informed that our B here, which you're saying is the given as the cost basis divided by the asset value at the start as 1. So multiplied by 1 there. So how much do we get at that instance there? So just working it out, 1 there equals, I'm getting 5,009.25. I hope you're getting the same, 5,009.25. And just as the way we had done under the accrual taxation component there, the gain after tax, so the gain after tax, which you're saying is going to be 5,009.25 minus 1,000, because 1,000 was the beginning value there. We're getting 4,009.25, like that. Then, with no tax, just as the way we had done under the simple accrual taxation regime, we are just going to, with no tax, we're just going to get the 1,000. We get 1,000 multiplied by 1 plus 0.1 for 20 years. And we're saying we'll be able to still remain with the same answer that we had gotten, 6,727, which we have over here, guys. You can see it here, please. 6,727.49. So 6,727.49 were there. So we're saying gain no tax. Gain no tax is just going to be the 6,727.49 minus 1,000. Over there is 5,727.49. So once we get that, we can be able to compute the gain lost on taxes. Gain lost on taxes, guys, you can be able to see. Let me pick another pen, another colored pen over here. This value and that value over there. So we get the 5,727.49 minus 4,009.25. How much do we get there? So 5,727.49 minus 4,009.25, 1,718. So it's 1,718.24 there. So that one is very important over there. And can we be able to get the what we can say, that's the tax drag, 1,780. That's the tax drag as a figure. But in terms of percentage, how do we get it? We already have the formula with us, given to us there. The tax drag. So the tax drag we're getting in terms of percentage. So tax drag in percentage. We're saying is going to be given as what? Is going to be given to us as this gain, no taxes, divided by the value 5,000. This the tax drag. So we just get the tax drag. This is actually the tax drag, not the gain. Tax drag divided by the no tax gain. So you're saying the tax drag is 1,718.24 divided by 5,727.49. We have it there. 5,727.49. How much do we get there? 1,718.24 divided by 5,727.49. 0.49, 0.299. So you get 0.299 or 29.9%, approximately 30%. Like that. That's how we compute the deferred tax capital gains.